What's up, boys and girls? Old Uncle Toot back with you once again. So this week we've got another commodity video for you, but this week instead of gold we've got silver. So why silver, Toot? Why would you care? Well, I'm a gold bull, but to inherently be a gold bull you must be a silver bull as well, right? Because they sort of run hand in hand. They're a little bit different. Gold bugs might tell you one thing or another, but in the history of time they've sort of run congruently, right? So in the last 100 years or so, gold's been a little more bullish than silver. However, there's a historical average of recorded history of about 5 to 10 ounces of silver to 1 ounce of gold. Well, the last 100 years it's been closer to 50 to 1, so that's a little different, and I think we should probably anchor ourselves within the last 100 years of that 50 to 1 rough average. But if we look at the silver to gold ratio right now, it's more like 76 to 1. So there's still some room for sort of regression to that mean, and maybe if you're, feel like stacking something, maybe silver is a little bit more potential to get you just a little bit, more percentage out of it. Not saying it's better, not saying it's worse, something to think about. And we can look at the chart and, of course, do the fun Elliott wave on it. So another, in general, why am I excited about this chart? Well, this is the weekly chart, and we go all the way back here to early 90s when we completed, this is the logarithmic chart, by the way, where we completed an impulse off the low, and then we corrected from, when is this? 2011 all the way to 2020 and put in a solid, weird looking three-wave, but a solid three-wave move down to correct. And then from that level where we went down and bottomed around $11, of course you couldn't get it for that, bottomed around $11, and then we have created an impulsive move off of that. And as we see here, as labeled, if we follow this theory, this impulsive move cannot be a C. Should not, I should say. Importantly, should not be a C. Meaning that after a corrective wave, once we see this go up, after a corrective wave, we should see at least a similar magnitude impulsive wave, motive wave on the other side of that. Well, we've seen the corrective wave, and it sure looks like we're starting to come out of it now. We're not out of there yet. Why don't we zoom in and look a little closer and see what there is to see? All right, if we zoom in here a little bit to the 2-day, we see that impulsive move that I was talking about off of the low of the zigzag that completed here. We see that it is denoted by strongly expanding non-overlapping waves, which is followed by a simple zigzag, which is of course anything but simple, denoted by these jagged moving overlapping waves, right? And is difficult as corrections and bear markets are, we were able to correctly and strongly identify pivots all throughout this correction, including the final pivot low here, as you could see on Twitter at Sensei Tutum. And now the projection is that we have finished either a 2 or a B at this level so that we can then continue on to more bullish targets. Now, of course, it doesn't mean that we have definitely completed to this point because we've only had a simple zigzag. This could get more complex. However, due to the magnitude of this wave relative to the magnitude of this wave, I would feel pretty comfortable saying that it's a decent probability that this is the finished correction to this level. Let's go ahead and zoom in at the most recent price action and see if we can make heads or tails of where we're going next. All right, down here on the 4-hour chart, things are a little bit funky in that this first structure down here is hard to count, although we've had a very strong move off the low, followed by a deep retracement and a very strong move that followed in the same direction. And in times when counts are a little bit difficult and janky to count, I typically suggest just using dominant pivots. And there's a pretty good argument to be made that this could be an expanding diagonal anyway, but there is also an opportunity that this could be an expanded reactive wave of a 2. Either way, we know the 2 ends here. It's probably safer for us to project and use this as our one high. And we did certainly break out of the base channel formed at that high and continue on to the 1618 wave relationship for a probable wave 3 to wave 1 using that relationship. So we'll happily call this the wave 1 high. Why is that important? Because if we come down and overlap this, then this would no longer be considered an impulse, but we would have to be cautious because if the wave 1 is down here and we overlap there, you know, it could mislead you. But I would think strongly if we come back below this super strong resistance or former resistance that turned into support, we would be in bad shape anyway. So using dominant swings, we've completed a 1618 extension with clear subdivision of 1, 2, 3, 4, 5 dominant subwaves. And it does appear we are sort of shaping up because you can see 1, 2, 3, 4, 5 swings in the fifth of that third proposed. So it's likely that we are probably in time to correct here, literally minutes after the FOMC just raised the basis points. The Fed funds rate 0.05% once again. So, no, I'm sorry, 0.5% once again. So you saw a little quick red wick down. I don't think that, you know, nothing unexpected here, but it does look like we're in the area of topping. If you look at this algorithmic entry, I tracked it all the way up and have only drawn the most recent. You see that we had a perfect 50 entry there. The target is just overhead at about 24.2. Oh, I'm sorry. Let's just get right on there. 24.223. So we could probably move up to there before that profit take hits. However, as we look at the oscillators, we're getting quite a bit of divergence. So be cautious. I do expect a retrace to put in a wave 4 that could last quite some time. In fact, if we have put in the high, we would want to go ahead and draw what is called our temporary channel to project for a wave 4, and the bottom side of this channel would be a minimum price expectation for that wave 4. So could take some time to get there. But once that does complete, why don't we go ahead and look at some price targets at not just this degree, but as we zoom out, varying degrees. Okay, so just to complete this impulse, and we'll go ahead and pull a Fibonacci, the length of the wave 3, from the proposed high, and we'll add a 382, and we would expect to come down to the 382, down to the 50 for a high probability area wave 4 retracement. In this case, based on this confluence of support, we'll go ahead and say just through the 382, and then we'll project from there 0 through 3 from proposed 4, say just below the 382 at 618 extension. So at this level, we would be looking when an impulse finishes here, and then of course once that happens, we need to go ahead and put 3 waves down. But before this thing finishes up, we're looking at about $25, a little over $25.50. Now let's zoom out and see if the larger degree projections continue on. How far can we go? Okay, out here at the 2-day level, a price projection for this level, very conservatively using the -236 extension of this move, retraced by this move, would be at about 34.38. The 1-to-1, little over 35, and of course, if it's going to be a wave 3, that's much higher. But conservatively, at the most conservative level, we would expect around the 35 area. And then, of course, if it were a wave 3, that would only be the third of the 5th advance that would potentially end up in this zone around $50, little under potentially. And then we would go down and up and continue on much more bullishly. Let's zoom out and take a look at where we really could go. All right, all the way back out here on the weekly for the price prediction. If we are in just a conservatively bullish market where we have actually completed the correction as labeled here, and the correction is done, and we are continuing on to a similar magnitude wave of this wave here, a very conservative target would be about $90, and this is the 2-3. Of course, we are looking on a logarithmic chart, I want to say. However, due to the price discrepancy within the moves, it is appropriate to look at this in log currently, and a very conservative in the log, -236 projection would be at about 90. More realistic, 1-to-1, 161. And of course, you could get much more bullish from there, over $1,200. Let's not get crazy. But if we only make it to 90, and even if you come out of a logarithmic, you're still over 60. So even if we go to 90, if you bought around 20, you're doing pretty good, right? All right, boys and girls, let's follow silver. Let's follow gold. Let's make money. And come on over to Transform Trading if you want to learn to trade it. Let's go.